It's not your support and resistance levels that matter. It's the reaction to your support and resistance levels that matter. And we'll go to the charts to look at gold. Let me take you to this week's Ninja Trader Charting Edge. A question I get a lot is, Anthony, what is the best way to trade the price action in gold? And to me, the best way to trade gold is futures. Now at CME Group, there are two different gold contracts to trade gold futures. And before we go to the charts, I'm going to quickly explain the difference between the two gold contracts. First, we have the standard gold futures contract. Symbol is GC. It is $10 per tick and it moves in 10-cent increments. This is equivalent to 100 troy ounces. Now you have the micro gold futures. It is 1/10 the size of the gold futures contract. It still moves in 10-cent increments, but it's 1/10 the size, so it's $1 per tick, and it's 10 troy ounces, and that symbol is MGC. So you really have two really good choices here, depending on your risk parameters on how you want to trade the price action in gold. Now let's go look at a gold chart. Now here we are at the gold chart. I pulled up a daily GC chart, continuation chart, and same old with the indicators. 20 period, 3 standard deviation Bollinger Bands. Red is the 10-day simple moving average, and that gold line there in the middle is the middle Bollinger Band 20 period moving average. Now, something that I talk about a lot, determining market environment. Bullish, bearish, neutral. Gold for a while has really been talked about by a lot of traders as been in a very bullish environment. You know, for me, I have to have proof of that. I go to my charts. Mouth of the Bollinger Band was open, holding above the 10-day simple moving average, grinding higher with the mouth of that Bollinger Band opening up. Now, how do I know the environment has changed? For me, it comes down to just one simple thing. When that Bollinger Band starts to come back in and that mouth closes, that tells me that at least temporarily, the bullish looking gold has stopped. Now, the one thing about using this type of signal to tell me if the environment has changed is that it changes well after the high is made. And for me as a trader, you just have to accept that. Because when I look at gold each and every day and it's been holding above the 10-day moving average, I don't know when that's going to stop, and I don't know when that Bollinger Band is going to start coming in. So I really don't even look to pick tops at all. This entire time was only a bullish look for me on an intraday trade. Now that we're below the 10-day and the mouth is closed in, yes, we're well below the high now, but at least I now have a range really that I can map out and manage my risk better. I now think that gold is in what I would consider a neutral to really short-term bearish, meaning that in the short term, if we stay below the 10-day moving average and that mouth stays closed, what I like to look for is 50% between the top peak and the bottom peak. I've talked about this a lot, and that comes in right around 1913. We actually almost got there as I'm recording here today. So to me, in this middle area now, I feel like it's just a two-way trade and probably look to sell rallies up near the 10-day moving average. I actually put a video out this week. You can go on my Twitter stream and see how I'm actively day trading gold with some additional indicators. But to me, this is so important to have in my strategy, to know just one side of the market that I'm trading. I talked about this actually in the last Develop Your Edge video. Know the side you're looking to trade. Here it was bullish. Now that's changed. Now I've gotten the signal below the 10-day. Bollinger Bands coming in. I now know that we are neutral to a little bit bearish. And who knows, we can come back down in this area. I'll look for some support areas and maybe we turn bullish again. But once again, we're boxed in. So I think it's a two-way trade. The only time I don't think we are a two-way trade is when I see this. The mouth of that Bollinger Band opening up. We're hugging above or below a 10-day moving average. To me, that's a one-way trade. Now we are in what I consider a two-way trade in gold. In my intro, I talked about how your support or resistance levels don't matter. It's the reactions to your support and resistance levels that matter. Think about this. Nothing is support until it proves to you it's support. Nothing is resistance until it proves to you that it is resistance. Just because you have a line on a chart does not mean that that is support or resistance. One of the most important lessons I've learned as a trader is the execution is all that matters. The analysis is important, but it's the execution of the analysis. So you could have the best levels that anyone's ever had, but if you're a poor executor of them, then your P&L isn't going to show up the way that your levels are telling you as good as they are. So what's important to know is watch for support to get tested. When it gets tested and it holds, that's confirmation that it's truly support. The same goes for resistance. I want to give you a quick tip before we go to the charts. Something I think about a lot that has helped me with execution is when we're in a bull market, the market is going higher. For those of you who don't know what a bull market is, and you have support, the one thing that I look at when it goes to test support and it holds, I'm willing to pay at that price or above because the trend is up. So in bull markets, when I see support tested, if it stops just in front of it or right on it and gets above it, I am committed to paying up for that price. Why would I say that? Because the primary trend is up. So my execution tells me that I need to step in when support is held in a bull market. How many of you have missed a long opportunity in an uptrending market because you didn't want to step out and buy it? Well, you just have to adjust your contract size and know that now that support is held or it got near support and bounced, that is a trigger for you to get in a bull market. Now that same type of thinking goes for a bear market. If I have resistance and the market goes up and tests my resistance and it comes right off of it, then it tells me to get in at or below that area of resistance because we are in a bear market. I'm going to give you one other thing to think about here that has really helped me with my execution is in a bear market, when you get support, right? Market comes down, tests your support, and it gets a little bit below your support, and you know that your risk price is just below here, and the market's getting really close to your risk price. And it's starting to show signs that it's holding, and it starts to work its way up. Now, for me, in a bear market buying support, I like to buy at or below my support, closer to my stop, to minimize my amount of risk. Why? Because we're in a bear market that's testing support. Why would I want to buy at or above support in a bear market? I want to buy at or below. So I look at that range of execution. So when it gets below support and I start to see that it's holding, once again, my support level matters. My risk price is all that really matters. So when I start to see a market hold in an area that I like for a potential long in a bear market, I like to step in closer to my risk price. And that same thing goes for shorting in a bull market. If the market is in a bull market and it rallies up to resistance and it hits resistance and it gets just above it, your stop is going to be just above there. So what I like to do is when it gets above resistance and it starts to chop or level off and it shows that it's starting to hold, I like to trade as close to my risk price as possible. So if I'm shorting in a bull market, I like to short above my resistance, closer to my stop, to minimize my amount of risk. These to me are some of the most important execution skills I've learned in my career. It's as simple as understanding that the reaction is all that matters. My support and resistance level is not the most important part. My stop is the most important part, and where I execute around my support or resistance is what really matters. Actually, let me show you some examples on a gold chart. Here we are back at the gold daily chart, and I've already identified that we are in a two-way market in gold, but ultimately gold has still been in a bull market as you look at the primary trend. We are pulling back into what I said earlier in a two-way trade, but overall the trend is still up. So let's use an easy example. This is not something I'll trade off of, but I think everybody can relate to it. You take off a previous high and you draw a line all the way across, and that comes in right around the high 1800s. Now, if the market were to pull back to there, a lot of people will look at that previous high, which was resistance, and now becomes support. We are in what I would consider a bull market, but a temporary two-way trade. I will not just step in if we go and test support. I will wait to see how it holds support. Now, if it holds that old high and bounces off it, because the primary trend as of late has been up, I am willing to step in above that support area and get long gold. Now, let's just use another example. Let's just say that resistance right here was this old high, right around 1980. If the market were to come up here and test this in an upward trending market, back above the 10-day moving average, and like I mentioned, when you are looking to short in a bull market or an upward trend, wait to see what it does at resistance and potentially sell above it. Now, let's just say it gets up to here and we're going to get a little above it and then start to hold and start to come back down. To me, I'd rather be late into a short retesting resistance than early. And I'd rather be in a little bit above it closer to my risk price. Why? Because the trend is up. Versus here on that support example that like I mentioned, once it hits here and holds, I'll step in because we are in a bull trend. I hope this helps you guys because to me, execution is everything. And these simple skills I've learned over the years from buying support and selling resistance, depending on the market environment, has helped me tremendously. We talked a lot about gold futures today. To learn more about micro gold and gold futures, go to cmegroup.com. I put this tweet out the other day. I said, it's funny how many people think they know if this is a good environment to trade in or a bad one. For some, it may be the best environment to trade in. For others, this may be the worst. Trading is personal. No one knows what's good for you except you. To tie this all back into what I said today at the beginning of the show and throughout the show, it's not your support and resistance that matters. It's the reaction to your support and resistance that matters. It's how you execute your strategy, and depending on the environments and how the market's reacting to your strategy, that determines if it's a good environment for you or not. This is why I've said many times, this business takes time. It takes experience to really know your strategy inside and out. Because as I've said a bunch of times, and this is controversial to many people, it's not really your indicators. It's not your strategy that really matters. It's how it resonates with you and your personality and you as a trader on the time frame that you're trading. This is what's important. This is why when people say be patient or be disciplined, how do they know when to be patient or to be disciplined? Sometimes you really need to be impatient. If it hits support and holds like I showed you today in a bull trend, I need to buy them. If it hits resistance in a bear market, I got to get short. To me, it comes down to knowing yourself, knowing your strategy, and identifying through the reactions of the market to your strategy, to your support and resistance. That determines if it's a good trading environment for you. Traders, I want to hear from you. In today's show, I talked about how your indicators or your strategies, they really don't matter. It's the reactions to your strategies and your indicators and your support and resistance that really matters. Do you agree with me? Do you not agree with me? Either way, let me know in the comments down below. Never miss an episode of Develop Your Edge. Click that subscribe button right there. You could also DM me on Twitter at Anthony Crudele. And don't forget to check out Instagram. Like I've said a bunch of times before, a bunch of cool stuff going on there, different from Twitter. You can follow me there at Anthony C. Crudele. That's a wrap for today. See you next week.